When one looks at a graph with some green numbers for some economic activity, it looks like good news for our economies. But that's obviously not always the case. The fossil fuel industry's business model is just one example of a business model that in the long run has some pretty destructive consequences. And that's the case for a lot of economic activity. In the end, there is a price society pays for it, even though the numbers look good on some company's balance sheet. In this video, I would like to investigate whether the price society pays for landlords has become too high. Can we really afford those landlords? And shall we phase them out like they were CO2 emissions? Part 1. Rent seeking. There is some debate about the extent to which landlords engage in so-called rent-seeking activities, but rent-seeking can be defined as when an entity seeks to gain added wealth without any reciprocal contribution of productivity. Rent and rent-seeking here refers to economic rents, which can be defined as income derived from ownership or control over a limited asset or resource.
There are two ways to create wealth, to get wealth. One of them is to make the size of the national pie larger and to get a share of that increase. The other one is to try to seize a larger share of the existing pie. And that's what rent seekers do. And in that process, they actually make the pie smaller.
According to economist Robert Shiller, the textbook example of rent-seeking is a landowner who installs a chain over a river that belongs to the land. Here the landowner employs a collector to charge passing transport ships a tariff to raise the chain so they can pass it with their goods. That doesn't make the economy more prosperous. On the contrary, the economy becomes less efficient as we now use workers to manage a job that doesn't contribute productively to the economy. It also distorts the market mechanisms. This happens among other things because the prices of goods are affected by this tariff, and now to a lesser extent by how much it costs to produce whatever goods they are selling. Innovation coming up with cheaper production methods also becomes less important. It will be more important to stay on good terms with the property owner so you can negotiate a more favorable tariff than your competitor. Inequality will most likely also increase as productive workers and business owners need to give a share of their productively earned income to an unproductive property owner. And that sounds pretty familiar, doesn't it?
Landlords, they win either way. So the more successful you are, the more rent they ask for. The less successful you are, the more demanding they are for the rent.
However, landlords will argue that their business model isn't rent-seeking. They will argue that they are taking on a risk by letting you live or work in their property. They maintain and may even improve the property. In addition, they also take care of various administrative tasks that create new wealth, and therefore it's completely fair that they are financially compensated with your rent. An essential question here is if the financial burden landlords put on society is comparable to the value they actually create. In many cases, it probably is, but I would argue that's often not the case if we look at a new generation of extremely aggressive buy-to-let and corporate landlords.
Trying to make this possible here.
Possible? You're literally trying to double my rent.
I own the property now, and
There's about 25 to 35% of the houses in this neighborhood are owned by Wall Street landlords.
If we look more structurally at the costs of these kinds of landlords, which we do in the next chapter, I would take it's even clearer which family of economic incentives this new generation of landlords belong to. Part 2. Inflation. When one get a loan from the bank, it's not money that the bank brings you from their bank vault, it's newly created money injected into the economy.
And you can read it on many central bank websites. That's how it works. Is that banks, when they decide the economy is good, we are optimistic, we are now making loans, they don't need to wait for any deposits, because when they make a loan, they create the deposit. Right there, banks create money out of thin air.
It may be difficult to imagine how banks can create money out of thin air. But let's say you pay your bank a visit, which in this example will be a bank called Blue Bank. You would like a loan of 500,000 euros, and in this fictitious example, they accept your loan application without any issue. Now they will enter the borrowed amount into the computer system, nothing more, and you can now shop around the housing market with a fake bank account. At this point, your loan is just a number in Blue Bank's computer system. You find a home and pay 500,000 euros for it, which you transfer to the old homeowner, who in this case has an account with Red Bank. Now Blue Bank must be ready to transfer 500,000 from their bank to Red Bank's customer. But in the end, they may not need to transfer any money, as this transaction will be a pending transaction for some time. In the meantime, I may also be house hunting. I therefore go to my bank, which in this example is Red Bank, and I also borrow 500,000 euros. I transfer them to the former homeowner who has Blue Bank, and now there is a pending transaction of 500,000 euros from Red Bank to Blue Bank, and a pending 500,000 transaction from Blue Bank to Red Bank. The amounts cancel each other out, and neither of the banks need to transfer any money.
Because you're creating new money, but you're not creating new goods and services. You're simply...
They're constant, aren't they?
You're giving somebody new purchasing power over existing assets, and therefore you must push up asset prices. So this, you can draw a chart where you show, asset prices, land prices, property prices in the UK, and they will match very closely as I've shown in Japan and other countries.
If the supply of money in the housing market increases more than the supply of houses, then we get inflation in the housing market, just as corrupt banana republics get inflation when their central bank prints too much money. However, inflation is not just a matter of money creation, it's also a kind of crowd psychology. Let's say that the financial sector increases its promotion of mortgages and hands out more mortgages. They can, for instance, do so by launching new mortgage products, buy-to-let mortgages. A big theme of this video were, for instance, launched in most countries in the late 1990s. This will likely cause house prices to rise, and how do people react when they read in the news that house prices are rising?
If the price for carrots goes through the roof, you will want to eat other things. So prices go up, demand goes down, and then the price falls back again. There is a tendency towards equilibrium. But with houses, things are different. If prices go up, everyone wants to own a house to share in the capital gains. So demand for houses goes up more than supply.
It's like a bidding war for a goose that lays golden eggs. Who doesn't want to bid on a magical object that squeezes golden eggs out of its bum? Over time, this awareness of rising prices can turn into quite intense emotions. As this graph on bubble psychology aims to explain, a bidding war based on desperation, greed and delusional narratives, financed by money, created out of thin air, is quite an explosive cocktail.
And in this video, I'm going to share with you 4 ways that you can buy property without using any of your own money.
Kids, here's my advice. Get out of education because the schools don't teach you to be rich.
So how much do you buy to let landlords push up house prices? Will they both contribute to inflation by enabling the banking system to create more and more money, and they're also bestowing the bidding wars in the housing market with emotions such as greed and FOMO with their delusional stories on social media? I actually found an estimate from the UK from 2008. Here the British government agency National Housing and Planning Advice estimated that buy-to-let landlords had pushed up the cost of the average home by £14,000. Since then, the value of buy-to-let mortgages has tripled. Their emotional presence has also exploded with their enormous presence on social media. We must therefore assume that buy-to-let landlords influence prices significantly more today.
But I use debt. I borrowed $300 million after the crash, dollars. In 2000, by 2010, I had borrowed $300 million to buy real estate. That made me rich. And the interest rates kept coming down, so that my cost of money kept coming down.
Something else suggests that the global housing inflation crisis has more to do with the consequences of an uncontrolled money supply, and to a lesser extent, the housing supply, is that the housing surplus is actually increasing in most countries. If we continue to use the UK as our example, a study by the Collaborative Centre for Housing Evidence in the UK concludes that the housing surplus have generally been increasing for many, many years. Moreover, the surplus has increased in all English regions, even in London, where house prices have risen the most. Part 3. Financial risk. The reason why banks can create money out of thin air is because a loan is both a liability and an asset for the bank. It's a liability because the bank needs to put 500,000 euros into your account, but it's also an asset because the bank now owns a contract that says they will be paid 500,000 euros plus interest. And if the payments do not fall according to the obligations of the contract, they can also force you to sell the house and collect the outstanding balance via foreclosure. The bank can even sell your mortgage to another bank or investor. If the bank sells your mortgage, they have created what's called a mortgage-backed security. In other words, this new money entering the economy is based on a bet that the value of the loan as an asset will not fall below the value of the loan as a liability.
When they're creating new money, they basically just issue out new digital casino chips, as it were, right, when you're asking for loans.
We saw in 2008 what happens when banks bet wrong. Neoliberal fairytale economics dominated finance and monetary policies in the years leading up to the 2008 crisis. This was, for instance, manifested by a historic deregulation of the financial sector. In the same Wall Street-friendly spirit, Western central banks began experimenting with very low interest rates, insurance of risky investments, and new techniques for financial bailouts. That brought about the perfect conditions for creating lots of that casino money, which the financial sector then used to finance various financial bubbles. There were, for instance, the bubbles that burst during the Southeast Asian financial crisis, the dot-com bubble that burst in 2000, and later the housing bubble.
I mean, you have these private profit-seeking banks creating up to £200 billion a year and pumping that into the economy wherever they want, basically, wherever it suits them.
The political and financial elite completely ignored that creating too much money for unproductive purposes, like houses that's already been built, just results in inflation. When inflation in 2004 began to spread from the housing market to consumer products, the Western central banks found it necessary to raise the base interest rate. So when mortgages got renewed, people did not only have to pay for houses that were historically expensive, they also had to pay off their debt at a higher interest rate. Many of the poorest homeowners and the most risk-taking landlords couldn't afford that. As a result, the number of foreclosures and unpaid debt exploded.
And the fact is that these mortgage-backed securities are filled with extremely risky subprime adjustable rate loans. And when the majority of the adjustable rates kick in 07, they will begin to fail. And if they fail above 15%, the whole bond is worthless.
The combination of high house prices and a higher interest rate also led to far less demand for buying a house. This caused house prices to fall, and now the collateral in these mortgage contracts were also worth less. Naturally, the value of the financial sector's mortgage assets plummeted, and the casino chip money that the banks had created out of thin air was based on the possibility that these mortgage assets could or would be converted into real money, either by waiting for the loan taker to pay their loan or to sell the loan as a mortgage-backed security. That led to some banks literally started to run out of money, which led to even more banks stop lending money to other banks as they wouldn't risk running out of money themselves.
The world's financial markets lost faith in their own system. Trust between banks evaporated. They stopped lending to each other, and the house of cards crumbled.
And since money is kind of the reason why most people have a bank account, that's a pretty big problem. That led to banks selling massively out of their other assets, such as their stocks, to raise enough money for cash withdrawals and money transfers. However, more banks selling out of their stocks and fewer banks buying stocks because they're holding on to their money led to rapidly falling stock prices. And now the financial sector's assets were worth even less. Suddenly, the value of the digital numbers that we look at when we check our bank account, aka the liabilities of the banks, were so out of proportion with the value of the assets that
We were a few days away from the ATMs not working.
buy-to-let landlords mostly operate with relatively thin margins percentage-wise. Therefore, a relatively modest increase in interest rates can often send them into financial trouble. They often have very little cash in reserve, and if they have purchased a large property portfolio, they will most likely have lots of debt. We were reminded of this in 2023 in connection with the interest rate hikes.
Property investment is very tough right now, and if you're anything like me and you got a lot of houses, there's some of my properties that were making me nice money. I was making a couple £100 a month. Now I'm losing money on, and it's the Bank of England's fault.
The price for having buy-to-let landlords is therefore also a higher systemic risk in the financial sector. If the dominoes begin to fall, we could be in dire financial trouble. Part 4. Conclusion. So can society afford landlords? Based on the arguments I have been looking into, I would say it's important to distinguish buy-to-let landlords from landlords who are actually able to buy a home outright in cash. If one can buy the home outright, the banks don't need to create new money to finance the purchase, and there is relatively little or no systemic financial risk associated with the purchase. In theory, such a landlord has also earned the money through productive labor and paid tax on the money earned. The economy should therefore, at least in theory, have expanded similarly to what this landlord has been paid as a salary to save up for the house. However, the case is quite different with buy-to-let landlords. It's difficult to see that their productive contribution to the economy is big enough to justify 1. The financial hindrance to put on productive labor and entrepreneurship, 2. The amount of inflationary money creation, and 3. The increased systemic financial risk they cause to the economy. So it must be about time to phase out buy-to-let mortgages and order the banks not to print any more money to landlords.